Hey everyone, and welcome back to Wealthstone. We're now well into the summer, and there's certainly no shortage of things happening in the markets. Let's start with Iran, because this continues to be one of the biggest risks on the radar. Back in the spring, we talked about the disruption of the Strait of Hormuz and the sharp moves we are seeing in oil prices. Well, unfortunately, that story hasn't gone away. The situation has continued to shift between periods of escalation and attempts to bring the different sides back to the negotiating table. And the markets are reacting to nearly every development. When tensions rise, oil prices can move higher very quickly. And when there's news of a pause or progress in negotiations, we can see those moves reverse just as fast. That matters because the Strait of Hormuz is one of the most important oil routes in the world. Any concern about supplies moving through that region can affect energy prices, and eventually the price of transportation, food, and a lot of other things we buy. So, even if you don't own an energy company, this story can still have an impact on your portfolio, and probably on the price you're paying at the gas pump. For now, I think that the best word to describe the situation is unpredictable. And markets generally do not love that. Now, let's move on to the more encouraging part of the update, corporate earnings. Because despite the geopolitical headlines and the uncertainty around interest rates, companies have been putting up some very strong numbers. Early in the latest US earnings season, the large majority of companies reporting results came in ahead of analyst expectations. And importantly, the strength hasn't been limited to just one area of the market. Most major sectors have been reporting year-over-year earnings growth. Now, there is an asterisk here. A few very large technology companies have had an outsized impact on the headline numbers, so we don't want to get too carried away with one big percentage. But even after adjusting for that, the underlying results have still been quite strong, and that matters. Over the short term, markets can move on headlines, interest rate predictions, or geopolitics. But over the long term, earnings are what support the value of a company. If businesses are growing their profits, generating cash, and continuing to invest, that creates a much stronger foundation for the market. So while there are definitely risks out there, the earnings picture is giving investors a good reason to remain constructive. Now, let's talk about interest rates, because this is where things get a little bit more complicated. For a while, investors were mainly asking one question: when will central banks cut rates? But now the question is becoming, how much room do they actually have to cut? Here in Canada, the Bank of Canada held its policy rate at 2.25% in July. The Canadian economy has been fairly weak, although we are starting to see some signs of improvement. Normally, slower growth would make it easier for the bank to lower rates. But inflation has moved higher again, largely because of energy prices and some of the costs connected to the conflict in the Middle East. So, the Bank of Canada is in a bit of a balancing act. Lower rates could provide support to consumers, businesses, and the housing market, but cutting too quickly, especially if oil prices remain elevated, could make it harder to bring inflation sustainably back to the 2% target. And the Federal Reserve is dealing with a similar challenge in the United States. The US economy has remained resilient, investment in artificial intelligence has been very strong, and companies continue to report healthy earnings. That gives the Fed less urgency to lower rates. So for now, both central banks are watching the data and keeping their options open. Basically, it's a lot of wait and see, which isn't the most exciting answer, but is probably the sensible one. Now, let's zoom out and look at the bigger picture. We have geopolitical uncertainty, we have energy prices adding some pressure to inflation, and we have central banks that aren't ready to declare victory or commit to a clear path for interest rates. But at the same time, corporate earnings are strong. Businesses are continuing to invest, and the economy has been more resilient than many people expected. But when we step back and look at the underlying fundamentals, the picture is more balanced, and in a number of areas, actually pretty encouraging. This doesn't mean markets will move in a straight line. They never do. But it does mean there's a good reason to stay grounded and stick with the long-term plan. So, to wrap it all up, tensions involving Iran continue to create uncertainty, particularly around oil and inflation. The direction of interest rates is still unclear, with central banks taking a cautious approach, but many corporate earnings have been very strong and continue to provide support for equity markets. So, stay patient, stay diversified, and stay invested. As I often say, it's not about timing the markets, it's about time in the markets. Calm in the chaos, that's the Wealthstone way. Thanks for watching, enjoy the rest of your summer, and we'll see you in the next update.